Karina Rodriguez Gutierrez is joining me today, and she has been a financial advisor for over a decade, right?
Over 2 decades. Over two decades, actually.
And she now is principal of Exfinia Financial. So, Karina, you're going to share with us today, and you have some things to share with us about just your finances. So tell us how we can, some saving strategies that are going to save us money. Tell us what you have to tell us today.
Yes. And actually, thank you, Jennifer, for hosting this program, this webinar. I find that a lot of time people diversified only against market risk. They do have their conservative and liquid investments, then their intermediate, and then if they tolerate, they have their high risk investments. But very few people diversified against tax risk. And that is what we are going to talk about today. Depending on when we pay the taxes and how we invest our money, the results we can get could be completely different. So we are going to talk about the 3 different ways to invest according to taxes and how different the results can be. I'm going to be sharing very quickly a screen.
And while she's doing that, we do have a chat button in the top left-hand corner. It's a blue box chat button. So if anyone wanted to ask us anything, they could do so.
Okay, great. So can everyone see my screen?
I can see your screen. Yeah.
Okay. So we are going to talk about the 3 different ways to invest according to taxes. The first category is the ongoing tax, anything that we have liquid. We have in this category savings accounts, checking accounts, CDs, mutual funds if they are in a brokerage account. In this category, we are paying a price for having the money available to us at any moment. The price we pay is having to pay taxes every single year on the returns we have on this money. Therefore, this money is not as efficient as it could be. Of course, we need to have money in this category, but only the absolute necessary to cover our monthly expenses and our emergency fund, which
so
by the way,
what do you suggest? Like 3 months? Is that what we should have in kind of a savings mutual fund that's just really liquid?
Yeah, bare minimum between 3 and 6 months of monthly expenses. We should have it in the liquid category.
Okay.
But the rest of the money that we want to save for medium to long term needs to be in these other 2 categories. The second category is the tax deferred bucket. In this case, we have all the retirement plans, the 401ks, the IRAs, the annuities. In this category, since we cannot touch the money until we are 59 and a half, the reward that we get for that delay is that that money is not going to pay taxes now. It's going to grow tax-free. But when we are going to start withdrawing that money, we are going to start paying the taxes. Now,
so whatever tax bracket, like, I mean, right now I'm in the highest tax bracket, but when I'm retired, hopefully I'll retire by 59. But so if I'm at the 20% tax bracket at that time, will I pay 20% tax on it, or am I in the capital gains tax bracket?
No, you will be paying depending on how much money you withdraw.
Okay.
So starting from the basis that at least we want to keep the same standard of living that we have right now during our retirement years, correct?
Right, yeah.
At least we want to keep it. So let's assume that today we live with $100,000. Well, by the time we retire, we want to have at least the same $100,000 to keep our standard of living.
Okay.
So, but there's an inflation. Inflation also plays a very important role. So by the time we retire, those $100,000 might be equivalent to $170,000 just because of inflation.
Right.
And if we have everything in this category, we're going to have to withdraw $200,000 to pay taxes, have net $170,000 that are going to be equivalent of $100,000 of today.
Okay, got it.
We are going to be in the tax bracket of whatever $200,000 is.
At 30, probably 35%. Okay.
Exactly.
Got it.
Yes, we need to invest money in this strategy, but only if we have a matching contribution from an employer. Let's assume we work for a company and we have a matching program, and let's assume this employer is matching 5%. Well, we need to maximize that contribution from that employer. So we can contribute 5% in order for them to match the other 5%. That's what we should do, because if we don't maximize the contribution from the employer, we are going to be leaving part of our money on the table.
Okay, got it. So basically, what if I have a 401k and my company does not match? Should I not do that 401k?
No, maybe not. Maybe you should be better off investing in the third category, which is the tax advantage products. In any of these products, in any of the strategies in this category, you pay the taxes now when we think they are lower. Because, by the way, if you research the historical taxation rates in the US from the 1900s, we are on one of the lower levels we have ever been. So the tendency in the future might be that the taxes might go up. I mean, we don't have a crystal ball, but that's what history shows us. So if we think there's a strong possibility for taxes to increase in the future, why do we want to defer them? We rather pay them now on the money we invest. If we keep any of these strategies, the money can grow tax-free and we can withdraw it tax-free, which means we never pay taxes on the growth of that money. We end up paying taxes on less money versus here you pay the taxes on everything, the money you put in plus all the growth. And in this one, you only pay the taxes as you invest the money.
So question. So basically, possibly, and if I was someone that didn't have a financial advisor, I completely suggest that you call Karina. We'll have your information at the end of this, right? So basically, possibly, if my company's not matching my 401k, maybe it's better for me to put money that I would have put in the 401k into one of the things in the purple section. Exactly. The Roth IRA, which has some limits. The 529 is for your kids, right?
Mm-hmm. And the 7702C is a hybrid product that combines the insurance industry with the financial industry. Okay. The tax advantage comes from the insurance industry, and the larger potential growth comes from the financial industry. By combining both, you get the best of both worlds. You get the tax advantage that the insurance industry gives you, plus the larger potential growth that the financial industry provides. Let me show you, before we continue, do we have any questions on these slides before we move to the next one?
I think I'm okay. I think we're okay.
Okay, so let me show you a quick example on 3 individuals. All of them are saving the same amount of money, $5,000 a year, and they are doing it for 30 years. Everyone is getting a 10% return, and everyone is paying the same amount of taxes. Everyone is on the same tax bracket, 28%. The first individual saved in the first category, the ongoing tax. Every single year, his money was being affected by the taxes. Therefore, it only grew to around $525,000, and he's going to have net $38,000 per year during his retirement years to spend. The second person invested in the second category, the deferred tax. Since his money was not being affected by the taxes every single year, his money was more efficient. His money grew to around $905,000. But he's going to have to pay taxes when he withdraws the money. So net, he's going to have $65,000 per year for his retirement years. The third person invested in the tax advantage products. His money was not being affected by the taxes either every single year. So he got to the same place, to around $905,000. But his money already paid the taxes, so he will not have to pay taxes when he starts withdrawing the money. So net, he's going to have $90,000 per year to spend. The main difference comes because he didn't have to pay taxes on the growth of that money. So imagine the three individuals save the same amount of money for the same number of years, everyone got the same rate of return, and everyone paid the same amount of taxes. But this person is going to have a much nicer retirement versus this one and this one. So it's not only important to save, it's important to save in the correct tax strategy. And that's what we want to take out today from this brief webinar.
Can you tell us a little bit more about the 7702C, just because I don't know much about that one?
Sure. That is a hybrid product. As I said, it combines the insurance industry with the financial industry. The insurance industry is an industry that is a very strong, solid, therefore very conservative, but it offers a lot of tax advantages. On the other hand, the financial industry gives you the potential of higher growth, but it doesn't offer you any tax advantages. Every single year, we need to be paying taxes on the growth of that money. If we combine the two industries, we get the best of both worlds. We get the tax advantage that the insurance industry is providing, plus the higher growth that the financial industry is providing. The money we invest is after-tax money. The money grows tax-free, and we can withdraw it tax-free. That's the main difference. Another very advantageous thing from this instrument is that all the money that is invested under the umbrella of the insurance cannot be touched in case we are involved in a lawsuit. If we are involved, for example, in a lawsuit or in any legal trouble, anything that is outside from our 401k and our main residence could be really, really exposed. Any investment properties, any brokerage accounts, bank accounts could be really exposed. Everything that is invested under the umbrella of the insurance is totally protected. For example, doctors is a group of professionals that really like to invest in this instrument because they know that their principal is protected and guaranteed.
So Karina, if I wanted to get more information about this, if I'm interested in some of these, either in the green or purple section, I like your colors, how would I get a hold of you, and kind of what's the process? If you could just kind of visualize so people can visualize.
They can contact us at 281-798-6303. Again, 281-798-6303, or via email to Karina, KARYNA.Rodriguez, RODRIGUEZ, at Exfinia.com. And what's the process? Well, we will get them a complementary financial analysis. And what we usually do is we analyze all the holdings that the person has. If there are some recommendations that will make their portfolio more efficient, then we will let them know.
Okay, got it. Very good. Well, thank you for spending your time with us today. I really, really appreciate it. This is a great, simple, easy to understand slide. And I did not realize about that purple section. That's really great to know about those 3 instruments. People could really use the 529 to max out their kids' 529s now and just let it grow over the next few years.
Yes, they can. There's people that like the 529. There's people that don't like as much the 529, but that could be another discussion for another topic. Yes.
Well, thank you for your time today. I really, really appreciate it. I hope you guys will give Karina a call. She's been not only a friend, but a client and an advisor. We've referred clients to her as well. So hope you'll call her for a consult. Thanks, Karina. Appreciate your time today.